I'd like to welcome the former chairman of the Council of Economic Advisors under George W. Bush, Ed Lazear. Ed, thanks for joining me. I'm going to get right into it. I thought the jobs number was jobs light. The revision of 20K over 2 months wasn't good. But wages on a month-over-month topped 0.4. That's the second time this year. You have to go back to September of 2017 to find a higher number. There's been several of those. But the big news, EPOP, employment to population, best since December of 08 at 60.9, and labor force participation moves up to levels at 63.2. We've had several, but that's really the best since 2013. Your thoughts on the report?
Right. I would say growing but slowing. It was almost an ideal report, to my mind, for this part of the business cycle. As you mentioned, the EPOP is up, the employment to population ratio. That's the number of people who have jobs over the number of people who could have jobs. It's kind of a surprise, actually, to still be growing. It was pretty stable, and it ticked up a little bit. You know, hopefully that will hold. We'll see where it goes next month. As you mentioned, wages are good. Wage growth at 3.2% is just about right on where we want to be at this point of the cycle again. So that looks good. The other thing that was good was the hours, average weekly hours went up by 1/10 of an hour. 1/10 of an hour is the equivalent of 400,000 jobs, so that's good news as well. So most of this stuff is really quite good, I'd say. The other thing that I always like to point out is, you know, you should look at the 3-month moving average of jobs rather than the single-month job number. And the 3-month moving average is 156,000. 156,000 is still recovery pace because we only need about half of that to keep up with population growth. It is lower than what we had last year. It's about 2/3 of what we had last year. So again, it looks like we're peaking, but just really quite a solid report. So I have no complaints.
All right. Listen, Ed, we only have 1 minute left. And real quickly, I want to hit on a big discussion we had this morning, which is the run rate of the U.S. economy.
Yeah.
And if you look at GDP in 2017, 2018, and the 2 quarters we have for 2019, you know, it certainly seems like 2.5% is very, very realistic. But yet, the assumption is we have a 2% run rate. Weigh in on that as an economist in a 30 seconds you have, will you?
Okay, 2.5% is realistic. Here's why. If you think about the 30-year average before the recession, it was about 3%. We're going to lose about 0.5 percentage point because of demographics. So that would put us down to about 2.5%. Now, that doesn't mean that it's going to happen, but we certainly don't have to suffer delusions of grandeur to get there. All you need is about 2% productivity growth, and you're at 2.5%. And we could have more than 2% productivity growth. So it's feasible, even if it's not most likely. It is certainly feasible.